Everyone, I'm Georgia Fisher from Lend and welcome to LendDD What's Driving Asset Finance webinar. Danelle's on her way to Perth this afternoon, so I'm stepping in. Today's webinar will be hosted by Andrew Moulds, our Head of Asset Finance, and some of the topics he'll be chatting about with our panel is JobKeeper, drivers in the market, opportunities for brokers, and much more. So before I hand over to Andrew this afternoon and introduce you to our panel, please remember this is a live webinar. We would love and encourage you to interact with our panel. So use the chat function or raise hand function at the bottom of your Zoom screen to ask any questions. So let me introduce you to our host and our panel for today. Andrew Moulds, Head of Asset at Lend. Scott Thompson, Senior Business Development Manager at Pepper Financial. James Ross, Managing Partner, Grow Finance. Matthew Richards, General Manager, Group and General. And Darren Smith, National Sales Manager, SME Fleet Partners.
Hi, everyone.
Welcome, everyone, and over to you, Andrew.
Thanks, Georgia, and welcome everybody. I think on a Monday afternoon, first day of the week and the last week of May. So if we wind the clock back, really this time last year we were coming out of some prolonged COVID lockdown, and I think it's interesting to note that it's only 2 months ago that we were seeing a flood crisis on the eastern seaboard, and we had the government removing the JobKeeper subsidies at the same time. So I guess off the back of that, I'll start with you, James Ross from Grow. What are you seeing in terms of those impacts, I guess, from the JobKeeper subsidy coming out and from some of that activity in terms of that flood crisis at the end of March? I guess, are we seeing anything? And also, I guess, second to that, what are you seeing in terms of asset classes that are showing either growth or decline for the Grow business?
Yeah, thanks, Andrew, and thanks everybody for joining this afternoon. So, as far as JobKeeper is concerned, really, from our perspective, we're not seeing much of a change at the moment. I think that could be to do with the fact that it is only still quite recent. I think the cash flow boost, I think it's called, is also stepping in and helping with some of the issues and helping to support businesses through, the difficult times. But certainly, if you look at all the indicators, the economy seems to be performing quite well. SMEs being, the underpinning of the Australian economy in many ways, you would expect them to be going quite well as a result of those figures. With regards to asset classes is an interesting one. Certainly, during the pandemic, you would have seen a change in asset classes, whether it was growth or decline, and that would have been off the back of restrictions in the lending environment, with certain industries being deemed to be too risky to lend into, things like hospitality. But then on the flip side of that, you had industries like the logistics industry, which has performed particularly well. And continues to be resilient throughout. And, as we come out of the other side of the pandemic. So, as we emerge and things get back to normal, I think all asset classes appear to be back to pre-COVID environments where we're seeing, the same level of business from industries that you were seeing, even if they were impacted by, the last sort of 12 months.
Thanks, James. Scott, I think, Pepper's probably another one to have a good talk to in terms of your breadth of asset class you're seeing in the market. I think James raises some really good points that we're probably not seeing a lot of impact from the JobKeeper subsidy coming out. Economy's been quite strong. I was reading somewhere today that the job ads are at their highest since COVID hit us, and that applicants are actually at their lowest. So there's a good sign that employment will continue to improve. Would you kind of echo those sentiments of James?
Yeah, exactly the same. And I can't believe I'm actually saying it, but we actually loved transport during COVID. It was one of the real positives. It's been sort of a dirty word for the last 10, 15 years. And we were sort of throwing money at people in transport. So it's funny how those ebbs and flows really come through. One of the biggest things we did notice coming out of COVID, though, was a lot of people with their toys now, with caravans, boats, jet skis. Obviously, international travel is going to be a little bit of an issue. So we've seen a lot more uptake on those sort of asset classes. And, look, always in Australia, your earth moving, your civil is going to do really well on the commercial side.
Yeah, clearly continuing to be a lot of investment from government in infrastructure. So one of the things that I wanted to have some discussion about today was, Matt Richards, I'll throw to you on this particular comment, is when we're looking at things like JobKeeper coming out of the market, I know I've seen some instances already where we've had some clients that are, outside of that probably low doc space, and they're looking for potentially larger lends, but they've now got a set of financials that are showing some JobKeeper payments, potentially some cash flow boost money that's sitting in their revenue lines. How do you think that plays out for lenders, I guess, over the course of the coming 6 to 12 months as we start to see those financial statements that potentially have this, this variation that's sitting in there as a result of what we've seen over the last 12 months?
Yeah, that's a good question, Andrew. And firstly, thank you very much for having me here today. I'm very excited to be partnering with Lend and to be invited along. I think the challenge for all of us working in finance today is to assess clients on their situation today, not their situation in 2020. And the thing we've found in our business is that we've had to spend a lot more time understanding what setbacks they had in 2020, because being realistic, I think all businesses had some form of setback, but we've seen different rates and how quickly they've come back. James and Scott have already talked about transport. That's a perfect example. The demand for transport probably went up through COVID because more people were shopping online. There was disruptions in freight and logistics and things of that nature. And then things like international travel obviously are still turned off, and a lot of the businesses that are maybe tied to that are going to have a little bit slower recovery than others. And we've seen a lot of businesses that maybe have been benefactors of people's changing behavior, either through consumer buying or things like government stimulus, things like the home buyer grant, or even smaller, more nuanced things like people buying a caravan to take a holiday domestically. So that's changing a lot of businesses. There's clearly been some businesses that are winners and losers. And the thing that we've seen a lot of is that clients really need a solution that fits where they are today. And change has happened so quickly that, we need to maybe give clients a fair hearing as to what income their asset is going to generate, what they're requiring it for into the future, and how are they positioned, and making a call on the industry and how likely we think they are to be continually impacted by COVID. And that's a difficult question to answer.
So if we took that position, and I think it's definitely similar for all lenders, there's some real challenge in here to have a think about how you make this assessment in such an unusual time. What advice do you think we can give to brokers in this space? We've got a lot of them tuned in today. What are the key tips that you give them if we're looking at that business that's maybe looking for an additional asset rather than a replacement asset, that's now looking to grow the business again? If they're going to start pushing these deals forward to lenders, what kind of advice would you be giving them about trying to make that position stronger?
Yeah, and that's another good question, Andrew. And I think, pushing the rewind button 12 or 18 months, all of our jobs were probably quite a lot easier. Businesses' financials didn't fluctuate wildly year to year. They didn't have things like snap closures, snap reopenings. And the biggest thing we've had to put a lot more time into and getting better at is understanding what those setbacks are. Can we live with them? How do we mitigate the risk of them? And I think to put it in a broker sort of lens, it's about spending more time with them and understanding where they came from, but also more importantly, where they're going, and maybe looking to non-bank lenders that will assess them based on today, not 2 years of accounts, because I just see more and more businesses not being able to get funding if the only thing you're going to look at is fluctuation between FY19 and FY20. Because no one's accounts are going to look good if you only look at a business through that lens.
James, just throw to James Ross here too. James, do you have a view on that kind of specific activity that brokers can take in terms of supporting those SME clients that are coming to them looking for these additional asset pieces?
Yeah, I think, disclosure is really handy. And I think that, not just in a situation like this, but really proving to the lender that you understand the proving to the lender that you understand your customer and the transition that they're going through from 2019 to 2020. Certainly, you've got to be looking forward in a lot of instances as businesses grow through and out of the pandemic. But interestingly, during sort of the last 12 months, I don't think it was ever a case of, these JobKeeper payments were really propping businesses up. They were assisting them, except you wouldn't lend to a business just because they had a JobKeeper payment. You would usually strip that out and make sure that they could afford it without it. And if the JobKeeper was helping them, in a lot of instances, it was just to prepare for a rainy day or to add some additional money in the cash flow account, then that was a real desired benefit of that little bit of government stimulus. So I think that the best bit of advice I could give for brokers would be to demonstrate how the customer is going to afford this as they come out of an environment where they were getting some support. It always comes down to serviceability, but things like future work contracts, work sources, letters and things like that, they're really handy in this environment. And certainly, they've been helping us to lend to people, who haven't had such a great track record as a result of everything that's been going on.
Thanks, James. Darren, I've kind of left you alone a little bit so far. So in terms of, I guess, your view of this play, and Fleet Partners is a nice, unique business for us to talk to in that sense, in that you obviously very motor vehicle specific, but quite a spread in terms of your customer base from that small to medium enterprise to the larger organisations as well. What's your view on this particular scenario where we've got some clients that are looking for those additional assets, maybe with a little bit of challenge now in a financial sense over the last couple of years?
Yeah, I think like the comments on JobKeeper and that for us, like it's probably a little bit too early to comment on that and sort of how that's all played out. From a lending capacity, we still view it the same as anyone else does, right? It's probably around serviceability initially. The benefit, I guess, with us is we're leasing assets over the long term. So, we want to try and help those clients through them as much as possible. And if they're looking to grow, we've got some scorecard capability to sort of add those on.
Thanks, Darren. Scott, probably back to you on the next question I have. We had a quarterly report that came out from Equifax at the end of March that showed that certainly the asset finance market was really booming again, right? So, in particular, the segments that Equifax highlighted were construction, agriculture. They made a very general comment about motor vehicles, which doesn't give us too much insight in terms of industry. What are you seeing in terms of industry trends for Pepper? In terms of what's really hot and bubbling? What are the industries, I guess, that you're starting to feel quite robust about in terms of support?
Yeah, so again, look, transport's a big one, Andrew, really robust on that, trailers, anything around that, as sort of Matt mentioned, that sort of, consumer buying and the delivery service has really gone through. So even down to couriers, to be absolutely honest with you, Andrew, everyone's updating their vans, etc. In terms of really robust industries, look, civil, there's always money being pumped in from governments for civil. You said the New South Wales government, Queensland governments, always updating some sort of civil projects. So we're very, very comfortable with those, right even down to sort of manufacturing. There's not a lot going on manufacturing-wise in Australia anymore, but what we do, we're very, very confident in that as well. One particular part where I know at the end of the GFC, a lot of businesses, where there's a downturn, there's obviously a lot of opportunity that comes after a downturn. And where we are seeing a lot of opportunities with tradies. And, I think we've all struggled over a long, long period of time for a reliable tradie, whether it be a plumber, a carpenter, electrician, just for them to say what they're going to do, quote what they're going to do, and then obviously clean up at the end of the job. There's a huge opportunity still for tradies. We've got a big shortage in Australia-wide for tradies. and you'll see a lot coming through for that as well. So we're quite confident with those young sort of guys that have done their 3 or 4 year apprentices and are now looking to start their own businesses. That's a real good opportunity.
Yeah, there's a huge amount of government support happening in that sector as well, right? For apprentice wage subsidies and the like. So I think that's a great area of focus for our brokers in terms of that SME market, is to really push hard at trying to make sure that they're marketing to those clients, seeing those opportunities, engaging with their, particularly those clients that they have that are in trade, not just for the clients themselves, but also potentially for their apprentices, right? So are you seeing any other segments, James, I'll throw to you again. Are you seeing any other particular industries that you think are a real opportunity and an area that when we're looking at our broker network that they could target and certainly get support from lender based on industry?
No, I think that wrapped it up pretty good, actually. That's always the benefit of going first. You get to focus on all the good stuff. But yeah, certainly, one thing that I was just thinking of as we were discussing it then was everybody remembers COVID because it's obviously been such a huge thing. But, just before it, we had some pretty significant bushfires all up and down the East Coast. And, there's still quite a lot of work being done off the back of that. And I think that's where trades really come into it, but also infrastructure as well. Certainly, I think the comment was made that the government's never shy of investing in infrastructure, and the most recent budget's another example of that. I forget how many billions of dollars it was they committed to spend, but it doesn't look like it's going anywhere, and it's national too. So, as far as those industries are concerned, they're very easy to lend to at the moment, that's for sure.
And James, what's your view on health in terms of, if I look at, say, budget that we've just had, there's significant investment happening through aged care, women's health in addition to that. So can be sometimes maybe a little more difficult to isolate asset opportunity in there, but do you see that as an area that's...
Well, it's a huge thing, but it does tie back to construction. So a lot of those aged care facilities are quite significant, construction opportunities for businesses these days, and they just continue to pop up everywhere. So having that type of investment's only going to fuel that industry further. And, if there are parts of the construction market which may be sort of impacted by COVID and occupancy rates and things like that, that potentially the investment in aged care is going to somewhat subsidise that or help the construction industry through the next little bit.
Thanks, James. Matt, do you have a view on this industry piece, just to wrap it up?
Yeah, I do, Andrew. Much like James and Scott, we've seen a lot of growth in transport, logistics, trades, and to a lesser extent, infrastructure. So guys in the civil space, and that's really flowed through to a very tight supply on vehicle. And I'd encourage brokers to maybe look at opportunities that they may miss. We see a lot of people buying gear privately from auctions, funding things like refurbishments of gear, engine repowers, and obtaining money to fund certification of things like cranes, or even raising capital against gear they already own so they could import something from overseas that they can't source within Australia. A lot of businesses are having to be maybe a little more creative in trying to find the gear they need, because it's very hard to find.
Yeah, thanks, Matt. I think you've really hit the nail on the head in terms of supply, and it's a good segue for me over to Darren at Fleet Partners. Darren, I guess end of financial year, traditionally an absolute peak time for our motor vehicle industry. I think this year we've got some really unique challenges in there in terms of the global economic and environmental conditions that seem to be having a significant impact on supply. I guess for the benefit of the brokers and the audience that we have here, could you maybe just step us through, because Fleet Partners is obviously very close to that motor vehicle segment, what are the factors that are impacting supply in that segment? I guess what are the secondary impacts of that? and how do you suggest brokers tackle that?
Yeah, sure. Thanks, Andrew. So for those that don't know, Fleet Partners, we sort of span across novated leasing, which is your retail buyer, corporates, and then SME as well. So we're getting a pretty good mix of all customers across the market. And I think it's fair to say that manufacturer and vehicle supply, across the board is really, really challenging. It's impacting every manufacturer in different way and every sort of model really, particularly the higher demand ones such as utes and light commercial, probably feeding in some of the industries that we spoke to before.
Sorry, Darren, is that this? I'm hearing a lot about semiconductors, but I don't think it's that simple, right? It's probably bigger than just a semiconductor issue, right?
Yeah, I think you've got a backlog of demand, right, which is the first issue. So if you look at our business and probably a lot of corporates last year, there was a lot of uncertainty and not a lot of customers willing to reinvest in vehicles and replace vehicles. So I guess the output of that is we were doing a lot of extensions, and I know a lot of fleet management and corporate customers were. So you've sort of got, I guess, a 12-month lag of vehicles being pushed out into this year, where they're now starting to review what they want to do and whether they need to replace or add to their fleet. You've got the retail buyers, which is what we sort of alluded to before, that change in behavior that, now they're buying SUVs or they're needing a small vehicle because they don't want to drive public transport anymore and looking to get into those. And then, the last point really is the supply chain side, which is because of consumer electronics and all the chips that need to go into vehicles because of the technology and navigation systems and safety technology. You've now got this massive backlog right through the supply chain. So that's impacting manufacturers, right through to the bodybuilders and everything all down the line. So gone are the days you can walk in and just try and negotiate a deal on the weekend and drive out with a car. I was thinking about end of financial year. I'm not sure how many of those big sort of men flying around with the balloons in a dealership end of financial year sort of run out sale we'll have this year when you've got sort of demo vehicles being sold at new vehicle prices at the moment, if you can get your hands on one to sort of cater for that. So it's really challenging. I guess what we're sort of hearing is that's causing issues. One, at a dealership level, they can't get stock. They've got stock levels sort of 40% of what they normally allocate, and that's dealing with the demand side. And then, so I guess they need to think about how they shore up that supply. So you look at manufacturers like Toyota, they initially had extra chip stock that's starting to run out now. So they're going to be impacted as well. We're hearing things like certain dealers are starting to prioritize retail deals versus company and business deals because of the higher profitability. And then you've got manufacturers like Mitsubishi and others that are talking about down-speccing their vehicles or taking tech out in order just to get certain models or higher profitable models into the system so that they can start clearing that backlog. So it's a really interesting time. I guess the impact of all that is customers need to be a lot more strategic and thoughtful about replacing or adding vehicles. It's 3 to 4 months minimum to get a factory order. Some of that stretching out 6 to 9 months. And if that's an issue, then they need to be a lot more flexible on price and what sort of options or vehicle model they're looking for. So it's a really, really interesting time for us. I read just as recent as over the weekend they were saying stats of $120 billion hole this is going to put in the automotive industry on a global basis, they reckon, in terms of 2021. So.
Yeah, I think you make an interesting point that that dealers are doing an exceptional job from a pricing point of view. So I guess what they're losing in some of the volume, they're making up in some margin. But very, very important for, as you mentioned, brokers to be having that conversation with the client about when do you need this asset, and really thinking about making that decision quickly if they want supply, or looking at the alternatives, which was something Matt was talking about previously.
Yeah.
Darren, is there any bead on when we think this supply issue will start to ease?
I think that's the $1 million question, right? If you we're quite lucky. We deal with all the manufacturers and different dealership groups. if you sort of listen to them, they're talking about sort of Q4 this year, supply is going to start coming into the system. But, you know, there's still reports that the chip companies are, you know, not going to be till sort of early next year till they start catching up. So, you know, we've communicated to the market at least in the next 9 months is we're going to be expecting to sort of be in this environment. So, yeah, the more you can get out and talk to your customers and sort of educate them on this impact, that I think it's just going to help brokers and partners get in front of the curve and avoid disappointment.
Yeah, and I think you give some really good insight into the demand peak as well, that you have this pent-up demand, as you were talking about, from clients that have had to extend lease terms or make some shifts in their current, I guess, purchase cycle to be able to push that out. It's really, really, I guess, you know, it's just pushing so much extra pressure into the system. So within that, Matt, Scott, I'll throw over to you on this question. One of the outcomes of this problem, I think, can be that the new car market heats up and there's very little supply. We start looking at used cars and other sources. What are you seeing in terms of, I guess, secondary market and demand in that sector?
Yeah, look, hot. I would say, look, we're seeing, you know, 18 model cars, 19 model cars, Land Cruisers that have been sold for above what new car pricing is. So the issues that we're having on LVRs internally is an issue. We understand that issue. We're lending more on the head rather than what the asset's actually worth, because we understand that, you know, look, there isn't a supply around. These people need vehicles to be able to go to work and perform their jobs. So, you know, if someone is paying, you know, an LVR of 140, 150% on what it should be, then as long as the head's right, we're going to be okay with that. One thing to keep in mind from a broker point of view, though, we're not going to do the high residuals. So that's something to keep in mind. We're just not going to continue to roll them over, and in 5 years have another issue where potentially that car may not be worth what it is today, because the market will come back and flood with new vehicles. You know, whether that be in 6 months' time or 2 years' time, the market will bounce back.
Darren, would you echo that sentiment? I think, you know, you're probably in a better position than anybody. Fleet Partners is really a buyer and seller of vehicles as well as a funder. So do you see that the residual values will normalise? And I guess that's the challenge in asset. You know, we're doing, you know, 3, 4, 5 year terms on that asset. So trying to set a residual value today with the market so volatile.
Yeah, look, it's one of the big thing our credit and risk teams are thinking about, I think. But I think I would echo those thoughts. We're probably going to stay elevated for the next sort of 12, 18 months to even 2 years, like we spoke about. But that's going to taper off. I don't think we're going to have that dramatic drop back. But yeah, as you alluded to, we're quoting and ordering vehicles now on 4-year lease terms, and if they've got 6 to 12 months before they're even delivered, we're talking about what's the market going to be in sort of 4 to 5 years, right? So you got to think by that point there, you're going to have supply coming back in, and, you know, markets normalizing it, and that sort of getting back to normal.
And Matt, I guess similar question to you. If I'm a broker and I'm looking at a client that's purchasing an asset that does have an inflated value, from a lender's perspective, what are you looking for that broker to put forward to try and improve their their chances of getting that deal bought? What kind of actions do you see a broker needing to take to increase their chances of success there?
Yeah, it's a good question, and similar to Scott and Darren, you know, all of us have to some extent meet the market. Because ultimately, the old adage, a car is worth what someone's willing to pay, has never been more true. And there's been a bit of an education piece in our business in educating retail clients that it's actually a seller's market right now. You know, if you've got a car that someone's happy to sell you and you want to pull the trigger on it, we'll support you. And I think from a broker standpoint, just having things like a pre-approval set up ahead of time is critical. Because customers can quite easily miss out on the car they want, and they might be waiting 4 or 5 months to get another one if they can source one at all. So we're seeing a lot more pre-approval activity. We think that's a good thing. And we're probably taking a little more care on our side to make sure that we're valuing things based on what they're worth. But, you know, we don't want to have a problem down the road. You know, all of us are funding stuff that depreciates in value. None of these things go up in value. but I don't think this supply issue getting fixed anytime soon. It's going to be 6 or 9 or 12 months at least.
Yeah. James, I'll throw to you. We've got a question on this that's, I think, topical from one of the brokers, which was, what impact does the current high used asset prices have on lenders' asset valuations? Are lenders concerned about sharp drops in value further down the road and how that impacts their overall security position?
Yes, certainly. Every lender would be concerned about that. But as all the other panellists have suggested, it's the market that we're in at the moment. So you just got to try to balance it. The one variable that we can't control are manufacturers and how they're going to respond as supply comes back online. If they really hit the market hard, especially with models that are getting towards the end of their life cycle, then you could see some people get really upside down on LVRs. So, we've just got to be careful in managing that moving forward over the next few years. And, at the end of the day, nobody wins if a customer can't pay a car back. So we just got to make sure that we're putting people into the right loans which they can afford over the long term.
Yeah, I think you raise a good point about the obligation we have to the client in that process too. So yes, whilst the asset value is inflated today, and Scott, you kind of spoke on this quite well, which is that view of setting the balloon or residual value effectively. So I think when we talk about positioning with clients to get the best out of the current environment, it's talking to the client about the ability to put deposit into that transaction if they can, but also structuring the loan so that when we're presenting it to the lender panel, that we haven't gone excessively on the balloon value, that potentially if it's a higher LVR with no deposit, that we're setting a zero or a minimal balloon. So I think they're the key actions outside of the borrower profile that we want to see our brokers doing to maximise their success. Matt, in terms of outside of those vehicle classes, are you seeing volatility in any of the asset prices of other asset classes?
Yeah, absolutely. We're certainly seeing some inflation in truck and equipment values. Clients tell us that if they put an order on a prime mover or a tipper truck or something of that nature, they're looking at similar weights that you would experience with a light commercial ute or a van. And that is fueling the secondary market in that space as well. We're having to do more research to make sure that the purchase price is in line with the market, which is fairly easy to do if you want to make a call on that as a lender. And a lot of our brokers are working quite well with us in that regard, maybe finding things like comparable sales and stuff of that nature to make sure that the client's happy, we're happy, everyone's happy that the value that the client is funding and purchasing the asset for are all in line.
Yeah, and I guess off the back of that is the ability to do the second deal, right? So, if we don't structure the first one properly, then the ability to do the second deal tends to fall away a little bit. I was having a discussion with a manufacturer lender last week about this very issue in some of their GFE style programs, and they weren't making any real movements on those GFEs at all. For that reason, they're very keen to make sure that the client returns and is able to jump into the next transaction. Given that we're in the last week of May and headed into what is hopefully going to be a very busy June, James, we'd spoken about this a week or so ago, but in terms of what happens to everybody at this time of the year, we generally have a massive increase in volume. There's quite often a degree of frustration increase that happens along with that. So I really wanted to take an opportunity, given that we have lenders here, to talk about what happens in the lender when we get into this peak period in June, and specifically what can brokers do to try and improve their approval and their settlement rates, and I guess help lenders help their clients.
Yeah, sure. I'm sure it's a pretty similar thing to what happens in brokers. It all goes a little bit crazy. But certainly, I think the challenge that we have, not only at this time of the year, but in the environment that we are in, there are a lot of lenders, a lot of new lenders. And if they're not new, they may have introduced new policies off the back of relaxing policies that they introduced during COVID. So there's a lot of noise out there, and understanding where to place deals and qualification is very important. It's going to save you a lot of brain damage moving forward. So using intermediaries like Lend to qualify deals can be very handy. Speak to your brokers, speak to your BDMs and pre-qualified deals before you send them in. Don't be afraid to send a text because, they get 1,000 phone calls a day. But I reckon that's probably the best bit of advice. 5 minutes extra work now will save you having to resubmit it to another lender in a few days' time, which takes far more effort and time. So yeah.
Thanks, James. Scott, I'll probably throw to you on this topic as well. You've been in that broker space. You're in the lender space as a senior BDM. What's your advice to brokers in this peak time to make the best out of it?
Yeah, so being on both sides, look, it's interesting because both sides are exactly the same. It's head down right to the end of June. All the strategic things go out the window, and it's try and process as much as you physically can. So nothing's different from the broker side to the lender side, which is great because everyone's aligned at obviously doing as much volume as we can coming into the end of June. Biggest advice would be, look, with turnaround times with a lot of lenders at the moment, as previously mentioned, getting it right. So just taking the extra 2 minutes to speak to your BDM, speak to credit, make sure it's that particular financier's deal. If it's not, you're going to waste 3 or 4 days with a deal sitting in the queue to get an answer from credit where it's going to be a no. Then you're going to have to do the same process again with another lender. So every BDM, I know from our standpoint, wouldn't be afraid to answer a phone call to say no to a deal if it's not a peppered deal. A quick no is better than a long drawn out no, and at least you can move on. In terms of resubmissions and settlement irregulars, look, it's far better if you spend an extra 2 to 3 minutes, double checking the deal, making sure it's perfect. Because the amount of extra work that both a lender has to do, and then obviously, whether it be the processing team or the broker themselves having to re-sign documents, with the timeframes that's obviously in credit and settlements with a lot of the lenders at the moment, it just may not happen. So,
thanks, Scott. I guess the other problem can be if you've got those resubmission or in particular the settlement issues that you talk about. I guess quite often that deal will go back to the end of the queue, correct?
Look, we try not to because it's already been worked on. It's a case where, a lot of the analysts, I'm not sure about the other financiers, they should be picking up 2 new deals, doing their resubs and then continuing on in that sort of fashion. So the old deals don't go all the way to the back of the queue. But again, if a deal's been looked at 3 or 4 o'clock in the afternoon and then the information comes back through at 4:30, 5 o'clock, it's very, very hard for us to get that action quickly.
Yeah. And Matt, I guess that old adage of measure twice, cut once. Yeah.
Yeah, there's probably not much more I can add to what James and Scott has said, aside from the fact that I think all of us, whether you're a broker or a financier, we're all in the service business. And we live in a fast world now where people can order a pizza on their phone and they get an update when it's on the way. And finance has been a little slow to catch up with that. And I think the biggest thing for all of us to be more efficient is to match the right customer to the right loan the first time. And I think that's why we're so excited to partner with Lend, because we view your offering as giving a really high level of accuracy, and a deal that you pitch up is probably going to fit us, or it's going to fit Pepper, or it's going to fit Grow. And I think if we can all work together to facilitate the right answer first time, because there's so many lenders out there now that there really is a lender for every loan almost. And, I think that's the biggest thing for us, is to maybe not get disconnected about the customer at the end of it. And it's one thing that we try and make sure we don't lose sight of internally here.
Thanks, Matt. Obviously, we've got some exciting stuff coming in the asset space. So looking forward to working with all of our panel members on that. To throw to you, Darren, in terms of just really kind of capturing the real drivers or the influences that are impacting your business at the moment in terms of asset, and giving our brokers a sense of where can they focus some energy. What's really driving your business at the moment?
Yeah, I guess like ours are probably a little bit more macro. From a broker and SME side of things, we've really sort of had to look at this market and sort of realised, the SME customers, they're consumers that own businesses, right? They expect everything to be quick, fast, digital experience. So, to echo a few of the comments today, that's why, we're looking to partner with Lend as well. We've sort of aligned some of our policies around sort of speed to decision and opening facilities over the long term, which is alleviating these vehicle supplies. So it's about just placing an order and adding that to the facility rather than a transactional basis. But more macro than that, I guess, we've got some long-term trends coming down the pipe. Pretty much on the corporate side, a large number of our customers are speaking to us about, cleaner and greener vehicles. So, you've got hybrids coming in, and there's a lot of demand for those products, particularly the Toyota RAV4. And a little bit further down the line, the electric vehicle take up that we're seeing overseas, that will ultimately sort of start hitting here. So they're sort of the big ones. The last sort of macro on sort of over the top of that is this broader sort of trend to, mobility solutions and businesses really sort of looking at, what is the right fleet and vehicle policy for my business, and, what's the right funding and vehicle need. So, is it novated leasing? Is it purchasing the vehicle? Do I need this vehicle 100% for business use? Is it shared with personal? Are there alternative means of, sharing this vehicle amongst other staff within the business? So this has been going on for quite some time, but I think with COVID last year, like some of these trends are accelerating. You've now got people working from home. So how much are they using the vehicle? These are a few of the open questions we're sort of working through at the moment.
Thanks, Darren. James, I guess a similar question to you. What's the big drivers for growth at the moment? And I guess where do you see some opportunity or developments?
Big drivers for us. Competition is one thing that I mentioned. Certainly the market's heating up, and that's a really good thing. I think it was Matt who said before we're a little bit behind when it comes to technology in our space. And I think a really good comparison is the mortgage market. If you sort of saw what happened to it after 2008, where there was lots of new lenders, that entered the market, that really improved the technology and speed to decision. And it's continued to improve since then. I think we're now starting to see that in the asset finance space. And as the cost of funds remain quite low, there's a real race by a bunch of lenders to try to catch up with the banks and offer really competitive pricing and products and process. So I think the technology and competition are two really big influences that we're keeping an eye on, and certainly it's the space that we're trying to play in. So in a lot of ways, it's game on.
Yeah, look, I think it's a great time for the market. I commented last week that what our SMEs need is a healthy and robust asset finance market, and the more players and competitors we have in there, the better I think it is for the client. Certainly our brokers, I think, are taking advantage of that as well. Scott, from a Pepper point of view, you have a broad range of asset classes that you service and clientele. Where do you see the biggest developments?
So with Pepper, look, obviously we both consumer and commercial. We've got a system that's been released for consumer already at the moment, which is working really, really well. It's giving lots of efficiencies in the background. So the amount of volume that we can now pump out from a consumer point of view is almost double where we were previously. So we'll be a lot different business in sort of 6 months' time once commercial's rolled out into that system as well, and we've got a lot of those efficiencies to make it a lot easier for the user, which is obviously the broker.
Great, and Matt, I guess to finalise with you on what's driving the business for yourself, you're more of the boutique lender space.
Yeah, it's interesting. For us, I think the challenge is to balance technology against doing the little things right, like understanding your customer, taking more time to get to the bottom of the setback that they had last year through COVID and where they want to go into the future. And interestingly, it's technology that's creating some of those problems. I'm in the company of non-bank lenders here, and our business is driven by loans that are rejected by banks because of an algorithm. And I see there being more of that business and maybe some more non-banks. I think people don't have a connection with their bank anymore, probably because there isn't a branch. People don't wander into their branch and get money thrown at them anymore with no questions asked. But it's really just about keeping that speed to decision high and balancing it with a personal approach where you can take into account people's circumstance. Because I think when stuff is changing as quickly as it is right now, it's very important to maintain that.
Thanks, Matt. And I think just to wrap up, we don't have too many questions coming through at this point in time, but in terms of, I guess, those top tips, if you like, for our audience, our brokers that are out there at the moment, we've covered a lot of content in terms of industries that we know are running quite hot. We've talked about some asset valuations, I guess, technology development that's happening in our sector, and the proliferation of lenders, which is a positive. Scott, wrap up for me maybe your top three tips.
Top three tips. Look, obviously, know your client. I think Matt mentioned it before. Look, during the GFC, it was one of my biggest learning curves. Know your client, where they've been, where they are, where they're going. Put a bit of a story in place, and that will really help a credit analyst not just look at what's on paper, but obviously put the story around it. Second tip, look, just take an extra 30 seconds, as you mentioned before. Measure twice, cut once. We do try and do the same. Third one is, and I've seen this a little bit, a lot of brokers now are advertising clients' financiers' turnaround times and are working backwards to sort of say, get the approval now, which I think is absolutely fantastic. I know if we work backwards from June, you probably need to have the deal in for credit, say around the 15th or 16th, to have a chance of it settling by the end of June, which is, unprecedented from previous years. So, I've seen a lot of that. So, the more updates you can give your clients, the more updates we can give you, the better it's going to be.
Thanks, Scott. Darren, I'd throw to you on this comment as well. And I know that for Fleet Partners, it's almost a reasonably new engagement in that broker space. Having said that, I think you've got some product that is a little bit different as well. So some tips from you to the market that's serving the SME client.
Yeah, sure. I guess it's funny, we probably don't really have that sort of real peak demand in June end of financial year. Like our sort of demand coming through is quite stagnant due to the nature of the product. I guess what end of financial year does bring is a really unique time to sit down and review things with your customers. So having those strategic conversations, understanding what their growth plans are, what are their needs, what are their funding requirements, more broadly. Our product fit is an alternative product to some of the other ones out there. And I think if I take anything away from today's call, that there's just a lot of optionality and flexibility available for clients out there. So matching that customer with the right product and the right opportunity, I think is a really good time to do that now.
I'm curious to get some insight from you, Darren, in terms of, given that you have that BDM force as well that sits in Fleet Partners. So when you're sending your sales team out to have those SME conversations, I think you can really give us some insight here with that lens for brokers. What kind of things, when you send that team out, what kind of things are you looking for them to engage with, and the information you're looking for them to get back from those customers?
Yeah. So I guess for us, we're looking for customers that have got fleets of 20 and below, and probably where the opportunities or the needs we're identifying is maybe areas of the market that sort of haven't been addressed before. So maybe the customer's got owned vehicles that they've historically owned and not ever sort of financed or funded them. Maybe they're starting to, particularly now in the back of COVID, they're now sort of 12, 18 months older than what they were originally planning to be. So there's an increase in, service and maintenance costs and depreciation starting to feed in. So we're trying to, get some feedback on the age of the vehicle. Is it the right time to replace? Are they planning to grow? Do they need additional vehicles? And then looking at, I guess more broadly, the total cost of ownership of an asset and what that impact is to the business. So it's not so much about, what's the interest rate we're charging, but it's about if you chose, a Ranger versus a Hilux, that overall total cost of ownership could be a lot lower, factoring in all the service and the depreciation and fuel costs versus an alternative model. So the BDMs are being a lot more, strategic and thoughtful and helping sort of consult with these customers and adding value that way.
Yeah, I think it's a good time to have a discussion around whole of life cost, right? And we're certainly excited to be working with fleet partners around that product. I think it'll provide another potential solution for brokers that are in the marketplace, and also help them develop their own skill set. So, we're certainly in your space talking about a dollar solution, a rental payment as opposed to an interest rate. Where realistically the interest rate is one of those things that goes into determining cost, right? But it's not something that comes out of your bank account. So, Matt, in terms of your top tips, if you could give me kind of 3 things that you would take and give to that broker channel to get them through to June 30 with the best possible result.
Yeah, absolutely, Andrew. The thing that we see internally here is the brokers that secure the most approvals in the first instance. To echo what Scott said, they know their client. And from our point of view, it's not just about knowing where they are now and collecting the applications. It's also about where they want to go into the future. What's the equipment going to generate in terms of income? What can they do? Much like James at Grow, we rely heavily on other documentation like work source letters and bank statements and contracts. And I think the broker sometimes that doesn't get the approval either in the first instance or not at all, maybe hasn't taken enough time to do that. And if you do that enough times, you end up losing the business to other people. The other thing we've done in our business, and I think it would translate into the broker role quite well, is actually just reconnecting with customers. I don't know about you all, but the past year we moved to work remote, very easy to get disconnected. And the old adage, if you're not talking to your customers, someone else is. And that's very much happening at the minute. And again, a lot of our best brokers are back out there hitting the ground hard, knocking on doors, seeing people face to face, and understanding what their clients need moving into the future.
So, Scott, I'll come back to you just briefly. How can brokers get the conversation started with their SME clients at this time of year? I think we've lost Scott. So, James, I might give you that question. How can we have brokers reconnecting with their SME clients now?
Yeah, good question. I suggest if you're reconnecting with them now with the intention of having a strong June 30, it might be a little bit late, but certainly, we work in an industry where a deal settles and then you don't speak to them for 60 months, which doesn't really make a lot of sense. So I think that marketing or working out some kind of engagement plan with your customers across the life of the loan is really handy, and they can be things like working with your lenders when you get to end of term, which is a really common one. One that's probably less explored but equally as powerful is when you get to equity. So understanding your payout versus the value of the vehicle and engaging with them then. If you have any opportunity to engage with a customer, whether it's cross-selling, understanding their business, which everybody's mentioned a lot today, but understanding that they may require things other than asset finance as well, whether it be business loans or debtor finance or trade finance. There's plenty of products in our space which can help them with their cash flow needs.
Yeah, and I think there's a need to be open to the solution, James, right? So sometimes I think we can get a bit narrow in terms of thinking that it's one solution. I know that I had a situation only last week where there was numerous solutions for that client. It was about presenting those options, right? One was an asset, one was an unsecured lend. So it's about being open to that. So I think we've lost Scott. So Matt, I might throw back to you for some final comment about engagement with SME.
Yeah, I think re-engaging with SME is very important this time of year in particular, because particularly with our larger clientele, we often find that their accounting strategy is not compatible with their borrowing strategy. their accountant will do something that maybe is conducive to minimizing their tax or maximizing a depreciation claim or something else, but it might not be consistent with the growth plans that they have the following year and securing things like funding lines with lenders. And it's good to have those discussions, I think, to ensure that the accountant, the finance broker, the client, they're all kind of singing from the same hymn sheet and they can get where they need to go next year. Because I think we could all agree that funding is maybe a little harder to get, particularly if you want to get things like bank rates. And that's very important.
Yeah, I think you raise a good point, Matt, albeit we might be a little bit late, as James says, at this point in time, given that the financials would have generally had to have been submitted by about now. So, but I think it's a really valid point in terms of if brokers are dealing with those SME clients, having a conversation about your borrowing strategy and your financial position is really, really crucial. Particularly if you're not looking to, or you can't get access to some of those kind of lower doc lending products. Really, really important to try and engage with the client and even potentially with their accountant at the same time. So we're going to wrap this up very shortly, but a final comment, Darren, from yourself.
Gee, how do you give a final comment to summarise all that? I'll leave that to you, Andrew. But I guess just on the conversation side of things, if I haven't sort of made my point clear, I guess from a vehicle supply side of things, like these issues are going to kind of remain pretty prevalent over the next 6 to 9 months, right? So even kind of looking past May and June, the more you can sort of get out and communicate with your clients and understand their needs and what are their plans, on the back end of this year and going into 2022. I think that's going to put you ahead of some of your competition. We can help where, as mentioned before, not sort of doing transactional leases or financing and really establishing credit facilities over the next 12 months. So where with some of our partners, we're taking applications now and getting those facilities right. So that in the next 2 to 3 months, when they're ready to place orders or the vehicle starts coming back online, we're able to place them now. But the more proactive you can be, I think that's going to leave you well placed towards the back end of this year.
Thanks, Darren. I guess from my perspective, just to wrap up before I hand back to Georgia, it's a pleasure to have such a diverse group on our panel today. So to have yourself, Darren, from Fleet Partners, Matt, Group in General, James from Grow, and Scott from Pepper. It's as I think you pointed out, James, it's great to see the diversity in the market. I'd really like to thank all of you for your input, and Georgia for being technically wonderful.
Thanks, Andrew. Thanks, everyone, for joining us for our asset webinar today. Thanks to all of our panelists. I hope everyone enjoyed it. We will send out all of the CPD points either later today or tomorrow morning, and we hope to see you all next time. Thanks for joining us.
Thanks very much.
Thank you.
Thank you.